Hey, this is Matthew from Commercial Deal Junkie, and I'm going to be talking about commercial real estate financing, how I'm able to get financing for my commercial real estate properties around the country. If you don't know who I am, I'm a broker and an investor based out of Southern California, but I buy commercial property all over the country, Kansas, Ohio, Florida. So this is how I'm able to finance my real estate. Let's dive into it. So there's really four types of commercial financing. I mean, there's some of them are just a couple. I put them together because the way they function are similar. But I really think there's four types of commercial financing. Now, which one you use is heavily dependent on what your deal is. Is your deal stabilized? Is it not? Is it multifamily? Do you already have cash flow coming in? What's your DSCR going to be? So a lot of these depend on the size and then the type of property you're buying and the situation on that property. So that's how you'll kind of go through and decide which one of these is best for you. Now you got to remember that all of these do require 20% down plus. Most of them are between, in the 65 to 70% LTV. So you got to bring, between 35, 30, some cases 25% down. Now there are ways to get into commercial property without, putting that much money down, but it really comes down to partnering with others and maybe getting mezzanine debt or secondary debt to get in. But most of the ones we're going to be going over today do require a certain amount of down payment. So we're going to start with the credit union or the bank. That's like the lifeline of the commercial real estate industry. I think most to say, especially on the smaller side, if you're between, half a million and 10 million, 15 million, even in that range, you're probably still going to be using a credit union or bank. The relationship-based lending, that means if they know you, you can actually get better terms. It's weird. Like I was working with a credit union in Ohio, shout out River Valley Credit Union. And I did a couple deals with them full cycle. Bought the property, stabilized it, sold it, they got their money back, or I refinanced with them. And they saw like, okay, they kept getting appraisals like, okay, this guy knows he's a safer bet. He knows how to make assets worth more. So when I came back to them, I was like, they gave me, just without me even asking it, a quarter of a point reduction in my interest rate. And they called it a relationship-based discount. They also would give me lower interest rates if I have deposits at the bank with them. So if I go to River Valley Credit Union, and I open up a bank account and I put 100 grand, they'll give me a better interest rate on the money I lend. So there's a lot of relationship based, you can get to know the people there, get to know the underwriters, and they'll tell you what they're looking for, and you can build a relationship with them to get deals through. Next, you have flexible loan structures. Everything is negotiable when you're working with credit unions and banks. Now, typically the smaller the bank, the more, the terms are flexible. So a local credit union is going to have way different terms than like Chase. So I recommend to go with the smallest bank you can, or the smallest bank that will finance it. I love local credit unions that only have 3, 4, 5 branches because they'll be very flexible. They'll work with you, and if you work with deposits, or if you show them good faith and you do a couple deals successfully with them, they can really give you better terms. And terms are negotiable. So you can the interest rate, the prepayment penalty, the points to close. You can negotiate all of those. Now, the biggest con with credit unions and banks is that the loans are recourse. So that means that if the deal goes bad, let's say you buy a property for $1 million and then it drops, you borrow 800,000 on the million, or you borrow 750,000 on the million. The property is now worth 600. So your loan's for 750, but the property's worth 600 now. When you sell the property, you're still on the hook for that last 150,000. So you are liable for this loan amount amongst the remainder of your assets. And they have prepayment penalties are common. You'll have step down prepayment penalty. That means it'll drop every year. It might be 3%, 2%, 1%. And what prepayment penalties are is that if you sell the property or refinance the loan with another bank within a certain period of time, there's a fee. And that fee is typically represented as a percentage of the loan amount. So if it's a 3% prepayment penalty, you pay 3% of in this case, your loan was for 750. You pay 3% of that 750 as a prepayment penalty. And it'll drop many times. Sometimes it'll be 1% all the way around, for 5 years. Sometimes it's negotiable. And there are very aggressive prepayment penalties, but you typically won't find those with banks or credit unions. Those are typically called yield maintenance prepayments. And those, when you get those loans, you better know you're going to hold that loan for 10 years. And we'll get to those later. So that's credit unions or banks. The other thing about them is they typically don't have a minimum loan amount. So if you're just getting started and you're buying, a $500,000 loan, or you need $1 million loan, let's say it's a $1.5 million property, you're going to put $500,000 down, you're going to take $1 million loan. you're probably going to end up with a credit union or a bank. All right, next you're going to have life companies, life insurance companies, or what's called CMBS lending, credit mortgage backed security lending. Now, this is typically lending for large stabilized assets. If you look at like a lot of like regional malls and high-rise office buildings, that's when you'll start getting into this type of financing. Now, it doesn't necessarily need to be huge, but typically, they're not going to look at anything even 2, 3, 4 million. But I mean, you really got to be up there, and they're typically more stabilized property. This is also the only one on here that I haven't done personally, that I've only done research about to see, if the properties I'm buying qualifies for them. And it's just because of the size. These are typically, the deals I'm doing are still relatively small, so I haven't had any experience with life insurance companies or CMBS lending. But from what I understand, the interest rates tend to be really aggressive because these are stabilized, typically trophy assets. They're long term, so they could be 20-year, 30-year mortgages, and the rate on it will be fixed. So we're talking about long-term fixed debt. This is cream of the crop lending, but they have to be giving out so much. In many cases, either life insurance companies have so much extra capital, they're just holding on to these as hedging against their policies, or you have people that are literally going to bundle these and sell them to investors because they're backed by such quality real estate that they tend to trade similar to like a security would. They have very strict underwriting. This has got to be, oh, sorry, I forgot to mention, these are non-recourse loans. So that means if the property goes under, you can literally hand the keys back to them, and they're non-recourse. You are not responsible for the difference in equity. And a lot of investors love getting that bigger level just simply so they can start signing non-recourse debt. Everything I have signed so far, every property I have done so far has been with a recourse debt, simply because I've been using local credit unions, banks, hard money, private money. But they have very strict underwriting. This has got to be cream of the crop property. Little to no flexibility on loan structure. So it's just like it is. They give you really good terms, but it kind of is what it is. You take it or you leave it. Now, the only term that really sucks with these is the prepayment penalty. Because they're literally securitizing this loan. So that means you often have something what's called yield maintenance prepayment penalty, which it's like there's an equation where they figure out what is like the approximate yield left, and they make you pay it all at once. I don't even fully understand it, and I'm not gonna bore you with it, but it's essentially a massive prepayment penalty to get out of this property. So when you're using this loan type, you got to be aware that you're going to be holding this for a long term. You got to be comfortable that you're going to have this loan for a long period of time. All right. And then typically the LTV is 55 to 70%. They're not going to get as aggressive. The property's got to be pretty damn stabilized and be pretty large enough, and it has to be quality enough to qualify for life insurance company or CMBS. Next one is private capital. So private capital is essentially just raising money from people or finding an investor that you're telling them, I will give you, for example, an 8% return on the money you give me, and it's going to be collateralized by this property. So it is a mortgage. You're gonna write the mortgage. It'll be 8%, 7%, 9%. It's whatever you can negotiate with that one person. And qualifying for it is actually, it's just between you and them. So if that person feels comfortable with you, maybe they want to run credit, maybe they don't, maybe they just know you, or maybe there's a relationship there that's beyond that. Maybe it's a business relationship, whatever it is, that you're qualifying is only getting the private capital investor to say yes. So what you can do is you can go to Uncle John and you say, hey, I want to buy this piece of property. It's $1 million. I want you to lend me $800,000. This is the property. This is what I'm going to do with the property. I'm going to make it worth this much. I'm going to pay you 8% on the loan. This is what your monthly payments, this is what your mortgage is going to be every month. And you can literally get capital as your loan, as your financing for these deals. So the terms are highly flexible. You can literally do anything. It's just you and that person, whatever you guys come up with, whatever the private money. Now, I separated hard money capital. I have another slide right after this on the fourth. I separated that one because I think it's a whole different thing. Private capital, you can raise it from friends and family. You can find investors out there that are looking for a stable return secured by real estate. And you can get flexible terms, whatever you guys negotiate, you can get. They close faster because it's not like a bank that has to go through, loan committee and due diligence and all of that. There's no strict underwriting because it's just, like I said, getting the investor on board. In many cases, you do have higher interest rates because if someone is looking, they're looking at you from, it's always compared to bonds and what interest rate they can get at the bond market. And typically the people that go with private capital don't qualify for bank capital, or they're trying to get higher leverage. So in many cases, this can be a higher interest rate route. It doesn't have to be. You can negotiate with the private capital and get whatever interest rate you can negotiate. But typically, in my experience, private capital will lend a point or two higher than banks. So if banks are right now, I didn't put any interest rates in here because interest rates fluctuate all the time. But at the time of this recording, banks are lending at like 7.25. Private capital will probably be in the nines, if I had to guess. Now, keep in mind, you can negotiate it, but if you go out there, you Google private capital investing in the real estate, and you just go online and you talk to people that do this for a living, then it's probably going to be a couple points higher. Sometimes you have to give up equity. That is another thing, is that sometimes you have to, in many cases, they'll want a piece of the deal. Rather, if they see good upside, they'll want a piece of the deal rather than lending to it. So there is potential dilution of ownership. But at the end of the day, they are investors, so they're going to be asking about it, the property. You're going to have to likely send them some kind of recording, some kind of P&L, and you're going to have to keep them in the loop, send them checks every month. So there is an investor relation there. Now, they're not necessarily investors. They could be, private money. I don't really look at them as like, they're not equity investors. They're giving you a loan secured by the property, and you pay them every month. Now, the LTV can vary wildly. I've heard people that have gotten 100% LTV, so they got the property essentially for free by getting private money to lend 100% of it. Obviously, that's going to be hard to do unless you have good relationships, or you're willing to eat it on an interest rate. I know private money, but now we're kind of describing hard money at this point, which we're going to lead into, which will give you all the money up front, but they're going to be at a very aggressive interest rate. Next is hard money. So hard money is, there are companies out there or people out there that will give you a loan, typically for a very short period of time. It might be more aggressive on the fees, but they close fast. We'll go over the pros here. So it's extremely fast closing. There's a property that's in bad shape, which is typically why hard money is used. Property has to be in a good enough condition to qualify for everyone we had before. A lot of private money will require the property to be in reasonable shape. CMBS definitely, and life insurance companies, they definitely has to be in really good shape. Same thing with banks and credit unions. If the property's not making any money, if it's in bad shape, they won't lend on it. But hard money, they'll lend on pretty much anything, but they'll charge you an interest rate based on what they perceive the risk to be. So it's extremely fast closing. You don't need a lot of documentation. Now, some of them, the more documentation you can show about your interest rate, about your history, not about your credit score, about your history, they'll give you lower interest rates. And then the loans are typically short term. So it'll be 6 to 24 months. That means in 6 to 24 months, you either have to refinance or sell the property. So you got to make sure, you got to be damn sure you're going to be able to stabilize that property. Now, the interest rates are higher here. So you got to remember that these are, another word for hard money is called bridge loans, where you're using this as a bridge between buying the property and getting more stable debt, whether it's life insurance, whether it's credit unions, banks, whatever. You're trying to get a bridge between the two. So you use hard money as a bridge, but once you buy that property, you have to stabilize it as quickly as possible and start the refinancing process, or if you're flipping it, start selling the process. Number one, because it's a short-term loan, you don't really have a choice. You only have a certain amount of time to get this thing stabilized. The second thing is you're paying interest every month. You're paying interest rates. Your debt service is going to be high. You may get interest only, so you're not paying the principal. You're only paying the interest. But either way, you're paying a lot of, your money is costing you. So that every day costs you. So you really got to be able to move quickly when it comes to hard money lending. So this is kind of an honorary. I didn't put it at the beginning. It's more of like an honorary financing method, mostly because it's primarily for multifamily investing. This is Fannie Mae, Freddie Mac lending. It's essentially lending that's backed by the government. It essentially is the government, and they're giving loans out to people that have stabilized apartment buildings. It has to be, I think the rule of thumb is, don't quote me on this, stabilized revenue, over 90% occupancy for 90 days. Something like that. But anyway, you want to look into it. They change them all the time. You want to make sure that it qualifies, but it needs to be a stabilized multifamily property. They have very competitive interest rates. It'll be sometimes only a point or two above the 10-year treasury. Very aggressive interest rates. Long-term fixed, you'll typically see 30-year amortization. 30-year loan. So it's a long-term loan option where it really, where you're going to hold the property for a long time. They're non-recourse, which is something I didn't mention for hard money. Hard money is recourse. So if you sign a hard money loan, you're on the hook. But if you sign a Fannie Freddie loan, it's a non-recourse debt, so you can hand them the keys back. Now their underwriting can be flexible. They do have a certain box criteria of what they're looking for, but especially with multifamily, they have a certain amount of lending they have to do. So, there is a certain area in which they'll be flexible, but for the most part, the property needs to be stabilized. So the property has to be typically in a fairly good location, in a fairly good shape, at fairly close to market rents. Like it's got to be fairly stabilized. You're not going to buy a deep value add with Fannie Freddie financing. They also have strict borrower requirements. They want to make sure that your net worth is equal to the loan amount. So if you're buying a $3 million property, getting a $2 million loan, typically they want to see your net worth outside of your primary residence equal to or greater than the net worth. They want, solid credit score. They want to see experience from the borrower. And they do have very strict prepayment penalties because they're long-term debt. Typically, the longer the amortization someone will give you, the longer debt someone will give you, the more they don't want to let you out of it, because as interest rates change, the whole point is that they're giving you a lower rate because you're guaranteeing them by a solid property. You're guaranteeing an interest rate, so they want to get paid out on that. So if you want to get out of it early by refinancing the property, you got to be prepared to pay that penalty. So that's essentially, every situation is different. It really depends on the property you're buying. So if you're buying, for example, if you're going to buy, and you can create strategies with these to figure out what your financing plan is with the property. So for example, if you want to buy, messed up apartment buildings that you're going to clean up, you could go into bridge or hard money. Like I said, hard money is also called bridge. You could start with hard money, go in, stabilize the property as fast as you can, rent them out to markets, and then refinance into Fannie Freddie, long-term, low interest rate. You're going to cash flow. So it's like, it really depends. Fannie and Freddie will also go really high on the LTV, up to 80%. So you could buy something really cheap, stabilize it, clean it up, and then refinance to Fannie Freddie, do a huge, meaty cash out refinance. So every situation is different. I buy strip centers. So what I'll do is, at this phase of my investing journey, I'm buying strip centers and I'm stabilizing them. So I'll go in typically with bank financing, because the property doesn't have to be in the best shape for bank financing, but can't be falling apart. So bank financing, and then I'll stabilize it, and then I'll either refinance or sell. Refinance again into bank financing, but pull out equity, or sell. Or I'll go in bridge / hard money. Yeah, I'm going in at a 10% interest rate, but I stabilize the property as fast as I can, 6, 12, 18 months, stabilize the property, and then I'm going to refinance into bank finance. So really, depending on what property you're buying, what situation you're in, if you have relationships with wealthy people that are looking to give out mortgages, you could say, hey, let me borrow $500,000. I'll give you 6%. I'll pay you monthly. I'll send you a check every month, and you'll make 6% on your money. So it really depends on what your situation is on which one of these you're going to end up with. So you can combine them sometimes. Now, a lot of lenders don't like what's called mezzanine debt, which is like you have a primary debt and secondary debt. And most debt on real estate is secured by the real estate. So lenders will find out. It has to get recorded. So if you're gonna, a lot of banks don't want to see that you're also borrowing the down payments or the equity portion of it. But you can combine them. You can create what's called a capital stack. A capital stack is simply like, you're bringing in equity, and then you're getting a partner that's bringing in more equity, and then you're getting debt. That's the stack. Or maybe you come in and then you have a hard money lender, and then you have a bank that's supplying the most of it, and the hard money lender is helping you with the down payment. So secondary debt is called mezzanine debt, but it's also secured by the property. So I know we went over a lot, but these are really like the 4 different ways you're going to buy property. So either you're going to be through a credit union or a bank, life insurance company, you're going to get private capital, or you're going to do hard money and stabilize it quickly because you're going to be paying. I hope you guys enjoyed. I wanted to go over some time. I've been getting a lot of questions about how I finance commercial real estate and how I buy it. So these are really like the couple of ways where you can buy and finance commercial property. Enjoy out there. Happy hunting. Like, subscribe. I'm going to be putting out more videos on how I buy and flip commercial property. And I will catch you guys on the next one.